So implied volatility basics. So implied volatility in a basic term is the measurement of the expected move of a stock based on the option prices. We should probably underline option prices there because it's the biggest key here is that the option prices, give us the implied volatility. It's not the implied volatility that gives us the option prices. So implied volatility is a representation of uncertainty. So the more the markets move, the higher the IV will be. I mean, this is just intuitive that something that doesn't move all that much, it's going to have low volatility, low implied volatility. Something that moves a lot, like a Tesla, is going to have high implied volatility. IV measures the price, not the other way around. So it's in the Black-Scholes model, you're solving for implied volatility. You have the option prices, they're there. It gives you the implied volatility that ends up, being that number that we solve for. When looking at implied volatility on any of the expirations, it's based on the expected move of the stock for a 1 year time frame, but it's annualized and based on whatever expiration you're looking at. So a 30% or a 30-day expiration, the implied volatility, the option prices in that expiration spit out a number, which is the implied volatility based on a year. That expiration only has 30 days. So you have to adjust that implied volatility for the number of days. And that's why you don't see a linear value of option prices across the chain. When you look at a 30-day option that's trading at $1, you would think a 60-day would trade at $2 and a 90-day would be $3. It's not linear because those option prices are have a curve to them in that, there's less volatility further out in time. Those prices are cheaper relative to what you're paying for options in the shorter duration. Of course, you're going to have different implied volatility from month to month, week to week, quarterlies, leaps, all that stuff. They're all going to have different implied volatilities. And ultimately, the price of the stock doesn't imply a certain implied volatility. It doesn't mean that $100 stock, is going to have the same implied volatility as another $100 stock. It's all based on the option premium and the expectations of price movement in that underlying.
Yep. And I think the biggest thing here is that the implied volatility curve is not linear. We've been highlighting this every single day on this show, yes. In the sense that near-term options are much more heavily weighted in terms of implied volatility from the overall extrinsic value. If you were to just split it in half between implied volatility and time value, the near-term options will always have way more implied volatility value than the further dated options that have more time value.
Yep. And we're going to look at that when we look at our smiles and smirks visuals, which of course I put together in the PowerPoint, but they look like they were made by a 5th grader. It's okay. I'm still working on that. So anyway, IV and standard deviation. So this is just a very, very basic look of what different implied volatilities would look like in terms of where your one standard deviation is. So if you have a stock that has a 30% implied volatility, those strikes are going to be much closer to the stock relative to something that's got an 80% implied volatility. The one standard deviation expectation for that stock's movement is going to be way further out on the curve. And in the next slide, it represents where that same value is, all else equal. So if you consider that we're looking at a $100 stock with a 30% implied volatility and a $100 stock with 80% implied volatility, to get that same $1, you're going to be relatively further out on the curve with that 80% implied volatility. Now, the probability of those options expiring out of the money is the same, right? So we're going to the one standard deviation. It's the same, even though the strikes are closer for the 30% implied volatility. It's just a question of whether that realized volatility comes in less than that implied volatility. So, when you think about movements in the stock, like even a Tesla, that it's having a $20 move today, just to put some context on it, let's look at what Tesla's implied volatility is right now. So the 40-day implied volatility, it's projecting a $46 move, which means that it could theoretically be right back where it was, Friday within the next 40 some odd days. Now, when you get a 30% implied volatility underlying and you see that same sort of move, the expectation isn't that it could potentially go back to where it was. You're stuck in a small, assuming the volatility doesn't change, you're stuck in a smaller range to hit. So it's all about where realized volatility comes in relative to implied volatility. And we want to sell high implied volatility because typically the realized volatility comes in lesser than that.
Yes. And that's the key. It's not that selling a strangle in this 80% IV is always going to work because you're further away. You should expect to see bigger moves, but selling a strangle in a 30 IV stock, you still take the same risks. It's just that if there's a surprise, you're going to be in much more pain than if there's a regular move in an 80% IV stock. And for there to be a big surprise in an 80 IV stock, you would need a really big move like you see in Tesla today. But that's
even that move is like not outside the expectation. Like it doesn't, it's a big move relative to if you had a short put on or a short call. That call is definitely going to move, but it's not outside the projections. It would be different if you had a 20-point move in Apple, because that's well outside the expected move for a price movement.
Yep. And this is why we just prefer to be selling premium in higher IV stocks, simply because our monetary risk, especially if you just look at like the put side, the monetary risk selling a put in the 80% IV stock is lower than 30% IV because you're collecting the same amount and you're further out of the money. That doesn't mean it's going to work 100% of the time, but if we don't know the future, I would rather have the lower strike price or a higher premium for the same strike price compared to a low IV environment where I could just go and define my risk, do a diagonal spread, do a zebra instead, and not be at the mercy of a potential surprise for very little premium.
Good stuff. Now we're getting into the weeds a little bit. Okay. And we get a lot of questions on why don't we look at the implied volatility of the strike we're selling. And the short answer is that it doesn't really, it's more intuitive if you understand the shape of volatility and how volatility or where you are on the volatility curve, which is what we're going to get into here. So per strike IV is shaped like a smile. So this is assuming there's no skew. So you can look at this and think of it as like a normal distribution, but flipped upside down, right? So you have, your out of the money options have a higher implied volatility because and we'll get into that example next, but those at the money options, they don't move as much and as fast as those further out of the money options. And that's because you have to look at this on a percentage basis relative to the option price. And you remember the option price goes into implied volatility. So far out of the money options from a percentage change standpoint, they move much faster than at the money options. Even though the actual nominal dollar move is much lower, the percentage of the value of that option is much greater. So when you consider a one penny move in an option, an at the money option versus an out of the money option, if the at the money option is trading at $1 and it goes to $1.01, so it goes to 101, that's a 1% change in the option's value. When you look at a 10-cent option, an option that's trading for a dime, and it goes to 11 cents, that represents a 10% change in the option's value. All else equal, that option's volatility is much higher because it moved a penny and that's 10% of its value. This is the representation of that volatility curve relative to options, in that those further out of the money options, the rate of change and the percentage change in those options is much higher than what you see in your at the money options. Those at the money options hold value. The value change is lesser relative to the movement further out on the curve.
Yep. And the reason why at the money options have a smaller percentage change is because they have the most extrinsic value. And if you get a move in the money, let's say you buy an option at the money, if you get a move in the money, you're going to gain intrinsic value, but you're going to lose extrinsic value. So the percentage change, especially when you're starting with a higher price point, like we're showing here, is naturally going to be lower. Whereas if you're out on the strike plane and you're looking at 10 cent, 20 cent options and those move by 5 cents or 10 cents, that's a massive percentage change, even though the monetary value is lower. So that's why you see these implied volatility numbers increasing out of the money on the strike plane.
Yeah, and that dotted line is just the strike, and think of this as like just a price on the bottom.
Mhm.
The other point here, and this goes to all those studies where you see, us explain that out of money strangles, they go to 25 or 50% much quicker than at the money straddles. And that is because you have, just like the volatility, you can think of it from a different, from flipping this. So if I said the option went from $1 to 99 cents, that's a smaller percentage change than the option going from 10 cents to 9 cents. That's a 10% drop in value. And that's why, we don't want to sell the tails, because the implied volatility and the change is a lot more against you than it is for you in nominal value. But you get to the point where, around that one standard deviation is kind of a good place where you're getting paid to take the risk, but you're also getting exposure to that high implied volatility, that notional value that actually makes sense to capture. We're not trying to capture the 1 penny. We want the 10 or 20 or 30 cents.
Mm-hmm.
All right. So that is a more of a theory type slide, because we know that skew exists in the market. There are some stocks that don't have skew, but for the most part, if you're looking at implied volatility for most underlyings, they have put skew. So something like in a SPY or an Apple, most ETFs and stocks, they'll have that put skew, which is why put implied volatility typically is higher than on the call side. If it has put skew, it's going to be higher than on the call side. And that's why those puts trade more expensive than the calls. So if you look at selling a 30 delta put, it's going to be a more expensive, or it's going to be further out on the curve relative to the call. And that's because of the presence of skew. So it's always a representation of the velocity of risk. You can see there are stocks that have call skew, and the curve, the smirk will be flipped, and you'll have lesser implied volatility on the downside, more implied volatility on the upside. But this explains why, calls decay quicker in terms of the actual value that you get out of them. Puts stay bid because you have this kind of skew to the upside. And that's what we'll look in this next slide of, why put spreads are kind of slower moving than call spreads, why you don't have as much directional exposure with short put spreads versus short call spreads, why iron condors have short delta. That kind of all comes into play here when we look at that for that next slide. So here, when you have a situation where you have a smirk, so your puts, or you have skew on the downside, so you have a volatility skew to the downside and a IV smirk. As you get closer to expiration, this implied volatility gets more into the binary, 50-50 type shot distribution that we looked at, a normal volatility smile. So we're talking sub 10 days, even less so than that, 2-3 days, where the outcome of the price movement is 50-50. You get that sort of U-shaped normal distribution type event, because you have so little time left, right? With further out expirations, that smirk is going to hold, even if you have big moves in the short term, just because there's so much more time left until expiration. There's a lot more variance that can happen with the stock. When you get to 3 days or 4 days till expiration, if you're trading this weekly expiration, it's more or less a 50-50 shot, just because of how little time is left. And that's why that volatility curve gets more equal on both sides. And this is why if you're, selling calls, those calls move quicker as you get to expiration. Those puts hold value because they're already up on the curve, whereas the calls, are much lower on the curve in terms of implied volatility, and why those move, quicker.